Most people do not have the time, inclination, or skill to choose their own investments, whether that be picking individual shares or picking funds. Luckily, there is a whole host of managed portfolios out there where a professional investment manager will pick and manage investments on your behalf. All you need to do is pick the right portfolio for you. Sounds easy, right? Well, the problem is the way these portfolios are described, the descriptions given to these portfolios. And if you don't understand what these risk descriptions really mean, you could end up seriously out of pocket in the long run. So in this video, I'm going to explain what investment risk really is and what you should be focusing on, and help you understand what each of these risk descriptions for each of these different types of managed portfolios really mean. My name's Carl. I'm a chartered financial planner and regulated practicing financial advisor. Welcome to the channel. In these videos, I'm trying to get across points and guidance that will help you take control of your finances and find true financial independence so you can really go out and enjoy your life. I recently heard an advert on the radio for Lloyds Bank, and the advert was describing how Lloyds can help you invest by choosing one of their ready-made managed portfolios. They give you the option of a cautious portfolio, a balanced portfolio, and a progressive portfolio. Now, what these descriptions are trying to explain is the level of risks involved with each portfolio. So the cautious portfolio, for example, sounds like it's going to proceed carefully, perhaps be less risky. The balanced portfolio sounds like it's going to be somewhere in the middle, a little bit of risk but not too much. And the progressive portfolio sounds like it's really going to start going places. Now, most investment platforms will have a similar version of these portfolios and risk descriptions. AJ Bell, for example, describes their portfolios as cautious, balanced, and adventurous. And Hargreaves Lansdown also use these same risk descriptions as AJ Bell for their managed portfolios. This sort of thing really bugs me. These descriptions really get on my nerves. Using words like cautious or balanced can be very misleading. These kind of words will secretly sync with your underlying personality traits. So if you're naturally a cautious person, you're probably going to choose a cautious investment strategy. But what kind of risks are we talking about here? Now, there are lots of elements of risk. And I think most people, when it comes to investment risk, are worried about losing money. But if you're invested in a diversified portfolio of funds, then there's virtually zero chance of a permanent loss. Your money is going to be invested in thousands of different investment assets across the world. So even if one or two of those underlying assets went bust each year, it would hardly dent your portfolio. Now, what these managed portfolio descriptions are trying to do is to explain the level of volatility you could expect with each of these different portfolios. And when we talk about volatility, we mean how high and low your investment value will fluctuate over time. So for a cautious portfolio, you might expect very little volatility. You won't expect your investment value to change that much. Whereas for an adventurous portfolio, you might expect quite a lot of ups and downs on your investment journey. The first problem here is that volatility and investment returns go hand in hand. You can't have one without the other. So if you want low volatility, you need to be prepared to accept lower investment returns. And the opposite is also true. If you're comfortable with higher levels of volatility, you should be rewarded over the long term with higher investment returns. The second problem is that volatility is not the only thing you should be focusing on here. The biggest risk to your investment portfolio over the long term is inflation. Now, based on historical inflation, whatever something costs today, it is likely to double in price over the next 10 to 20 years. So your investment returns need to keep up with inflation in order to maintain your purchasing power. Some types of assets, like bonds or fixed interest investments, have failed to beat inflation over the long term, which is the same as saying you would have lost money in real terms. Now, a cautious managed portfolio is likely to include a high proportion of these bonds and fixed interest investments. So whilst you may feel you're not taking much risk with a cautious managed portfolio, you in fact are, because your underlying investments are unlikely to beat or even match inflation over the long run. And also, just because something is labelled as cautious and you expect low volatility doesn't mean it's guaranteed. A number of these cautious managed portfolios experienced falls of around 20% during COVID and also in 2022 following the mini budget. Even a balanced portfolio is likely to include a 40 to 50% allocation to bonds, which means this portfolio also struggles to beat inflation over the long term. The only strategy that is likely to beat inflation over the long term is one used in most adventurous portfolios, because these portfolios will include a high proportion of global equity investments. Now, we've spoken about the problems with focusing on volatility and how we need volatility to get higher investment returns. And we've also looked at why volatility is not your main concern. Your main concern and risk is inflation. But there's a third problem as well, and that problem is the risk of not achieving your financial goals. Now, I'm horrified when I see a young person choosing a cautious investment portfolio for their long-term wealth building, particularly if they use a cautious portfolio in their workplace pension, which if you're in your 20s, you're going to be investing this money for the next 30 to 40 years. Yes, you might be a cautious person naturally, but do you really want to be in a cautious portfolio that is going to give you less chance of achieving your financial goals in the future? It's also the same when you approach retirement. There is a tendency for retirees to become more cautious with their investment strategy once they transition into retirement. And this is understandable. You're moving from the phase where you're constantly accumulating and putting money back into the pot to a phase where you're starting to draw down and take money out of the pot. You probably worked hard building up your life savings, so I can understand why there's a natural tendency to become more cautious. But if your retirement is going to last 20 to 30 years, which it will do if you're someone retiring age 65 today, then surely it's a disaster to be in a cautious investment portfolio where you're automatically going to lose out to inflation. You're automatically destroying your wealth in real terms. Don't get me wrong, us as financial advisors need to take some blame here, as regulation has forced us to put people into boxes. If we send out risk questionnaires to clients and asking you a series of questions to determine what your risk score is, but until you understand what real risk is, of course you're going to choose answers that sound less scary. So it's time we flip these risk descriptions on their head for managed portfolios. I would argue cautious is actually probably the riskiest option for most people. And actually, most people probably need to be in an adventurous portfolio once you understand the risks properly. Now, of course, this is not advice. This is just things for you to think about. You'll need to consider your own position and decide what's best for you. But I think for most people, you might even question whether you need a managed portfolio at all. I mean, I think for a lot of people, just one global equity fund could be the right way to go. But that's up for you to decide. I hope you found this video useful. Please don't forget to subscribe to the channel because we've got lots more videos soon. So if you subscribe, you won't miss when the next one comes out. And also, the more subscribers we get, the more content we can make and the better guests and things we can get on the channel. Until next time, take care.